Okay, I want to make sure we go live on Zoom so that we can also have this link for some of our colleagues. Okay, good afternoon, everyone. I want to say good afternoon to Risk Free Standard Associate. And one of our duty here and something that we enjoy is to make sure we bring the course to your best knowledge. So if there's anything that you are not getting, you can easily ask question. And for those of you that will be watching online, is you can easily just go to our website and ask for Rich Standard Associate. Okay, class, we can start. Today we'll be looking at what we call employees benefits, and that is underlined under IAS 19. Now, when we talk about employees benefits, the various methods, in terms of employees benefits, we are looking at scenarios whereby what are those benefits that employees enjoy. And these benefits could be benefits maybe when they are still in service or when they are after service, or you talk about whereby there is also what we call terminations of that service. Now let's look at these benefits in their own contextual things. When you're looking at employee benefits, you could look at this from four instances. The first one that we're going to consider is referred to as what we call the short-term benefits. Short-term benefits. Having considered the short-term benefits, we'll be looking at the other classes of benefits that you can also get. Apart from short-term benefits, there are other benefits that an employee can enjoy in working with an organization. So we looked at short-term benefits first, and we analyze what are those short-term benefits, what are the things that we look for in the short-term benefits, what are those things that the benefits entails. Then the second one, we'll be looking at what we call the post-employment benefits. Are we there? Then the third one, we'll be looking at what we call the other long-term benefits. Then in the fourth instances, we will now be looking at what we call the termination benefits. Now, what are all these benefits in terms of what we have? When we're talking about the short-term benefits, I don't want us to start looking at what are the principles and all the underlying things. These are what you see in the notes that I've given to you. But when you're looking at short-term benefits, what are the examples of things that are under short-term benefits? You have examples such as the wages and salaries. Because when we look at short-term benefits, we are saying that these are benefits that are expected to be settled only before 12 months. So note that when you are talking about short-term benefits, are looking at benefits that is settled. We say that these include benefits either settled only within 12 months. So we have all those examples that I've given to you. It says salaries and wages. We have what we call social security, the social security contribution. We also have what we call the paid annual leave. We also have what we call the paid sick leave. We also have what we call the paid maternity. I want us to know that it's not only women now that's being given maternity. You also have what we call the paternity. The paternity leave. You also talk about examples like what we call the profit sharing or the profit share mechanism and bonus. So we have all these stated bonuses. You can also have injury services and other ones that we call non-monetary benefits, like the Medicare and all the rest. So you have all those under those points. But when we talk about post benefits, you'll be seeing things that have to do with the pension. Are you there now? Understanding what are the pension that somebody will have to collect after he has finished. And under this was you'll be looking at things that we have to say. And please, for post benefits, I will just have to give us this example. So when it comes to post benefit, you see things like pension. Are you there? Apart from pension, you also talk about post employment medical. Are you there now? You can also enjoy post employment medical care. You also have what called post employment insurance. Post employment insurance. Please, why I'm drawing more points on this is that before in your ICANN exam, you just see that the examiner will just give you things like calculation. But now the exam is going beyond calculation. You might be required to state some of these instances and what are the things that are associated with them. So, like for other long-term benefits, you can also see that that is also sometimes when you talk about deferred compensation. In this case, you can see things like what we call deferred compensation. In other instances of looking at this, please, there could also be some situation where you can get bonuses, which are not short term, but they are other long term, right? Then which are later than 12 months. Because you can have that. For those people that are working in some industry, you also have some things that we call sabbatical leave, which some of us enjoy as lecturers. Sabbatical leave. So you can see that is for that. Now for termination, I think for termination we don't need to start having a lot of issues when it comes to termination. Let me use the bold color so that we'll be able to see what I want to stress at that point. For what we call termination benefits, you see examples such as what we call early retirement. But the basic one I would love to use is what we call the redundancy payment. The redundancy payment. I'm still going to spread all these as we move ahead and so that you can get it. Okay, BB, what's your question? Blackberry, BBB, please, I'll prefer you use your name. You raise your hand, ma. Or sir. Hello? Okay. I could not get that hand. Somebody raised his hand. I couldn't get that. Can I go on? I started the class. Somebody said I should start. I started the class. So can we move on now, please? Now, having looked at all these scenarios and how they play out, I'm going to pick them one by one and then we'll explain how they relate to employees' benefits. So let's take the first one that we'll be looking at is what we call the short-term benefits. So let's look at the short-term benefits. from what we have said, and I want you to note that all what I'm explaining is also in the material that I've sent to you. So I'm just bringing it to summary so that you guys can get some things that we have. So in your material, you will see all those examples I've mentioned on page 2. So you can see those materials on page 2. So I've sent it to your WhatsApp for you to have a full detail of that question of the material. So you can see what I'm explaining here. So it will make my job easier. So yeah, we've been able to see what are the examples. We said short-term benefits if expected to be settled only within 12 months. We have looked at that. I'm giving you all those examples that you can see them. The post benefit, you have seen it as it relates to pension. And we said post payments, medical care, and all what we have. And from all references, I've used the following references you can see down there. Emily Wolf 2018, Advanced Reporting of ICANN 2015, Open Tuition 2016, ACCA SBR 2019. So that is that. So we have other benefits, of which I've also talked, other long-term benefits. There was also say what we call determination benefits, which I've shown graphically. So what we now need to go on now is our ability to be able to get all those relationships as they move. Benefit may be paid to an employee themselves, to their dependent spouse, or to third party. So we have looked at that. IAS 13 uses a great many important definitions and which we have seen. So all these definition is what I have shown us earlier. And that definition, you have it here. We have things like what we call employees benefits, either other than termination benefits, which is expected to be settled only before 12 months. Post-employment benefits are also the one that I've explained to you, other than termination benefits and short-term employee benefits that are payable after the completion of employment. You can see that. And we also have, there's also what we refer to as the other long-term benefits. Then we have the termination benefits. Now, please, from what you have said, the termination benefit, you can have it as a situation whereby an entity decision to terminate an employee's employment before the normal retirement. And it could be sometimes that the employee's decision to accept an offer of the benefit in the stage of his termination of employment. You won't want to wait till when they will tell him that, guy, please leave. You can have that being done in some situation whereby organizations will be telling you that the redundancy is having this, and do you want to go and collect this money, or you wait before we do downsizing? Now for this, we have it in terms of short term. The accounting for short term benefit is simple. The principles are just same as for any expenses that is accruing over a period of time. So this one needs no explanation. It's like the normal way that we treat our expenses. So for salaries and wages. Under this condition, you see, because there is no actuarial assumption at all, it's very straightforward. How much is people's salary? If it's paid, you debit the salary account and you credit the bank account, which means the settlement. If it's not paid, you carry it forward, you account for it as an outstanding. And if it's paid in advance too, you also take that into proper consideration. Please note very well that the short-term employee benefit is an expenses in the period when the economic benefit is given. So you have that. So we also talk about short-term paid absences. When you talk about somebody absent, so we look at that also accumulates that charge to an expenses. You can have whereby somebody is not around, you have to pay him. What are the measurements? You have the measurements in terms of calculating. This is just normal thing that we do, and we have that to be done. So let's look at this question number 1. We are told that a company gives an employee, if you look at what it says, we say a company gives his employees an annual entitlement to pay holiday leave if there is an unused leave at the end of the year. Employees are entitled to carry forward the unused leave for up to 12 months. They are entitled to carry the unused for up to 12 months. At the end of 20X9, the company's employees carried, are you there now? We need carry forward unused element is total 50 days of unused holiday leave. And the employees we are having that they need to pay, employees are paid 100 per day. So class, what will be the amount that we need to consider here? But if I'm going to tell you this, state the required accounting for the unused holiday carried forward. If you am to ask you here, class, this question in terms of the benefit, is it a short-term benefit or a long-term benefit? Hello, class. Is it a short-term benefit or a long-term benefit?
Short term.
So thank you. So, and when you have the short term, it will be accumulated period of absenteeism. Are we there now? And what I want you to know is that those periods will be recognized in the law, and then you will be taken into consideration by the company. Okay. All these are not things that we have to do because for your level you have. Let's go to the second one, that is sick leave. Can somebody read the question for us, please? Who is there? Please read. Nobody is there. My people, read. The
Question
question is
2.
on your screen. Yes, please.
Flyman Co. has 100 employees. Each is entitled to 5 working days of paid sick leave for each year, and unused sick leave can be carried forward for 1 year. Sick leave is taken on a LIFO basis, that is, that is first out of the current year's entitlement, then out of any balance brought forward. As at 31st December 2008, the average unused entitlement is 2 days per employee. Flyman Co. expects, based on past experience, which is expected to continue, that 92 employees will take 5 days or less sick leave in 2009. The remaining 8 employees will take an average of 6.5 days each. Required, state the required accounting for.
Okay, in this case, thank you very much. If you look at this, we are told that the Plumber Co. expected to pay his staff for what they are to do. So here, what we are trying to look for is that what will be the additional days of the sick pay that we need to recognize. And this additional of the sick pay will be based on those guys, are we there now, that have used extra days. So what are those guys that have used extra days? So we need to calculate what is their own thing because it must be accounted for by the organization. So let's look at that. So I'm solving question number 2. So for question number 2, what are we looking for? We are trying to computation of the additional days. Now, if you need to ask ourselves, what is the prescribed days that is given by the organization? The prescribed day by the organization is 5 days. We are saying that the expected days is 5 days. But we were not told that we have certain numbers of employees that took above that certain days. And what was the average days that those employees enjoyed? What is the average days that those employees enjoy? They enjoy 6.5 days. So class, what is the excess of those days that they have enjoyed, the additional days? Additional days over the expected days, that is 1.5 days. Now that is the days that we're having, but that is not related to all the staff. So how many staffs were involved? So let's now look at how many staffs were involved. So for us to look at the total days, it will be related to the 8 staff, or we say the 8 employees that were involved. So if I have 8 employees, I either taking extra 1.5 days for their sick. So how much will be accounted for and recognized as a further liability for sick leave in this organization? I need your answer. Oh yeah,
12. 12 days.
12 days. Thank you very much. So that is the answer. And that amount must be accounted for. And that is the 12 days that we have. Okay. Let's quickly go to the other one, which is also something that is very simple. And I want us to quickly look at that. That is what we call the share of profit. So let's look at what happens when we have share of profit. I'm having some people who are not supposed to be in this class. If you know you are in skill, you are not to be in this class, because this is for corporate reporting. Okay. Who is Taufik? Is Taufik also part of my class? Please, who is Infinite Hotspot 6?
Yes, I should.
Taufik.
Hello.
Okay, sir. Can I see your picture, your video?
Wow. Okay, I will try and do that now.
Okay. Please, who is Infinite Hotspot 6? Infinite Hotspot 6. Hello?
The person cannot hear you. The person has not dialed into
So
audio.
that is not the challenge. Okay, Infinite Hotspot 6. So it
Okay,
means
can
that,
dial in now.
Okay, what's your name, please?
It's Jane. Good evening, sir.
Okay, thank you. Jane. Sorry, I want to
Yes,
change
sir.
that name to Jane. Okay, I think I've been able to do that. So I have Jane. Thank
Yeah.
you. So I've changed your
Welcome.
name to Jane. Okay,
Okay,
Tonya.
sir.
I also have Tonya. I also have Mr. Taufik. So I think I can relate with your name now. Oyelere.
All
You
right,
also,
sir.
okay, thank you. Okay, let's move on. So we have that for that value. Let's quickly go to another one now. We're now moving to the next item. So let's go to the next item. We are looking at the next item to be profit sharing or bonus plan. We have said that the profit sharing or bonus payable within 12 months after the end of the accounting. So we always have it that is something the organization can share. And this one is something you guys can relate with. Please note very well, when we are talking about the bonus or the profit sharing, is only given to those members that are still in employment. Are you getting that now? That are still in employment. However, it can also be people that are no more in employment. And this is what I'm saying. If an organization says that all the employees that will collect the bonus are those people that are working with us as at 31st December, but they can't determine the profit until when the year has ended, we'll not get all our records ready in 20, maybe the following year. So when they are sharing the profit, those guys in that employment in that date will collect the bonus and they will send it to them. So that's why you can see the profit sharing and bonus plan can fall within the short-term benefits and other long-term benefits. So that is why you're having it that way. So let's have question number 3 and then we'll move on. Okay, our reader, you are reading. Jane or Dami, read for us.
Please, where are you getting the question from?
Is in your material. I send the material to you on your WhatsApp, but I'm sharing it. What you are seeing now, I'm sure you are seeing something on the screen. Yeah, that which I'm sharing with you on the screen, I'll send it to your WhatsApp. But in case some of you don't have it, that's why I'm sharing my own. Okay, can you read?
Okay,
The question is
let me
on the
read.
screen. Yes, you are reading.
Morocco runs a profit sharing plan under which it pays 3% of its net profit for the year to its employees if none have left during the year. Morocco estimates that this will be reduced by staff turnover to 2.5% in 2009 required, which cost should be recognized by Morocco for the profit share.
Which course, please? John, Mumbo. Which course should be recognized by Morocco? It's very simple.
3%.
So write your answer. Okay, write your answer. We are writing. Morocco should recognize a liability and an expenses of 2.5% of the net profit. So what you are having is that the amount that they will take into consideration is 2.5% of the net profit, not 3. Are you getting that now? So whichever is agreed upon is that final one. Okay, let's quickly go to the next one, which we refer to. And please, when we are talking about disclosure requirement, there is no specific requirement for short-term employee benefit in the standard. There's none. So I don't want us to start beating around the bush and saying this and this. There's none. What you just need to do is to let us know normally in your notes to the account if there's any outstanding salary and what you have. So let's go to the post-employment benefit. Before now, I gave us examples of post-employment benefits. Can you give me examples of post-employment benefits? Where are my people? What are examples of post-employment benefits?
Pension,
Pension, great. What again?
medical care,
Medical care, post-employment medical care. Excuse me. Post-employment of medical care. Now, under this plan, like what we have said, I'm going to just run through two of these, but I will now go to the board. We are going to split it down, explain it. But if you now want to read more, you can now go to the material I've given to you. There are two types of post-employment benefit plan. We have what called the defined contribution plan and defined benefit plan. The defined contribution plan is simple to account for as the benefits are defined by the contribution made. You can see that one, there's no wahala, there's not big thinking. Now, why the defined benefit plans are much more difficult to deal with? Because the plans that you are talking about must be defined. It has not as one you promised, because this one is like saying what you're going to do in the past and you want to start looking at, and it's under the defined benefit plan that we need experts. But let's take the one that we generally know in Nigeria. If I may like to ask, which of these is now prominent in Nigeria? Defined contribution plan or defined benefit plan? Which one, please? Class, I'm listening.
I
Which
think
one
it's defined contribution plans, sir.
you think or you know, sir?
Because
Let's take
I've
it.
heard of,
thinking too.
I heard of that severally, and that's why I said I think. I'm not sure.
Okay, let's just look at the definition. They said defined contribution plan are post-employment benefit plan under which an entity pays fixed contribution into a separate entity, a fund, and we have no legal or constructive obligation to pay further contribution. That is what we have in Nigeria. Let's just look at this from the perspective of what we have. If you remember in Nigeria, before, our parents, they don't contribute money. What they do is that at the end of the period, when they finish working, they will be waiting for what the government says is going to give them. as their entitlement. But now what we are having is contribution plan. And the contribution plan is something that whatever you contribute is what you are going to have. So let me just take it this way. We have what called post-employment benefit, because I want to summarize this very simple and we'll just go. There are two, broadly classified into two. We have what called defined contribution plan, and we have the other which is called defined benefits plan. Now let's look at this. What this rule says is that you are having a situation whereby you are paying. Look at his own rule. He's talking about pay fixed contribution. And when you are talking about this paid contribution, let's use Nigerian scenario. In Nigeria, in line with the Pension Act 2014, I think amended now. Is it 2014 as amended? We now have two people that contribute into a fund. And these two guys are referred to as the employer and who class? The employee.
Employee.
For the employer in Nigeria, please, I'm picking the maximum amount that's to be contributed now is 18%. And most of you that are doing it, they will say 18% of BH, is it BHC or BTH? Is it BTH or BHT? BTH. That is basic, basic. Are you there? Basic salary, transport allowance, and housing allowance. I have an expert that just whispered into my ear now. She said maximum of 18%. So I think you will get to know that one. For those of you that you are doing fund, is it maximum of 18 or a minimum of 18? But that is it. But I want you to know that apart from what the law says, there's also what called voluntary contribution. Okay, I've just been told by the expert who is an expert. You know, I told you that I also have a teacher in the house. So, and I want to appreciate her. So she's also an ACA. So thank you. That's my wife. So she just told me now that it's maximum. He said minimum. Please, I'm correcting myself. Minimum. She's a tax expert, so she should know this one. Maximum. It's not maximum. They said minimum of 18%. And the employer will be paying 10%, and the employee will be contributing 8%. Please, what the law says is minimum. So I take that back, saying maximum is minimum. And please, you can also add that. So that's what we call a contribution. Now, for some of you that you get to see it, at the end of your service, they will not tell you how you pay. The way they operate, how you pay, how you will be paid after employment is not part of my own job here. So what we are looking at is that we have what we call defined contribution plan, where the contributors come in, are we there now, and they pay a certain amount. And please note very well, the underlying factor of defined contribution plan is that the contribution is paid regularly. And is paid regularly. So that's why they call it defined contribution plan. It's paid regularly. Are we there now? Now let's go to the other side, the other category. I don't know. Let me use this color. For the defined benefit plan, it has its own fundamental rules. Is that the benefit is determined in advance. Determined in advance. Class. The amount of the defined benefit plan is in advance. And that's why you always see that we need an expert. And please, that benefits are defined by the employer. So that is also another thing. Defined by employer. So they tell you, this is the amount you are getting. Now, there are now some conditions that are now attached to it. is that the size of the contribution is set by the amount that is expected to be earned over the investment. Because if they are decide this amount, then the money will not be invested. As they are contributing to it, the money will be invested. You will now say as we move ahead, there's going to now be a fund which will be created. And then they will also have what that fund will be working, and they will be telling us what and what we need to have. But I want us to underline the fact under defined benefit plan is that if it becomes apparent that the assets of the fund are insufficient, note and note very well, please, under defined benefit plan, and I have it under the note I gave you. If, however, it becomes apparent that the assets in the fund are insufficient, the employer will be required to make additional contribution into the plan to make up the expected shortfall. What I'm reading now, I'm not reading it from heaven. It's also in the material I've given to you. So I want you to look at that material, please. Let me quickly go down so that you guys will see that I'm not reading from. Now look at what I'm reading from. We are saying that the size of the contribution is set by the amount of investment and the return of obligation for the post-employment benefits. That is that. Now, if you read further, you will see what we're having here. I want somebody to read so that you will not say I'm reading from somewhere else. Somebody to read that for me. That which I've highlighted. Can you read, please?
If, however, it becomes apparent that the assets in the fund are insufficient, the employer will be required to make additional contributions into the plan to make up the expected shortfall.
Thank you. On the other hand, read on.
On the other hand, if the fund's assets appear to be larger than they need to be, and in excess of what is required to pay the post-employment benefits, the employer may be allowed to take a contributions holiday, that is, stop paying in contribution for a while.
Please, I want you to have that at the back of your mind. Anytime the examiner wants to test your understanding about the difference between defined contribution and defined benefit plan, that is what they will underline. Now, if you go to defined contribution, you can see from his own, we're told that with such plan, the employers and possible current are paid regular what contribution into the plan. Then after the contribution are invested, and the size of the post is what paid to the former employer, depending on how well and badly the investment are shaking you as performed. Somebody to read that, please.
The contributions are invested, and the size of the post-employment benefits paid to former employees depends on how well or how badly the plan's investments perform.
So class, I want to ask you now, for those of you that you are doing pension contribution now, it depends on whoever is your PFA, your pension fund administrator. Now will determine what you are going to get. I'm not here to demarcate any of them. I will advise you to check what is their investment portfolio. Which one is having the highest now? I'm not going to mention anyone. And which one is low. But you have to be very careful that you don't just pick anyone. Because if the investment perform well, the plan will be able to afford higher benefits. Then if the investment perform less, you will get what class? Less benefits. So in the case is like whatever you put into it and the way they could harvest it or plant it is what you get. So let's look at this now. It's also important to have a clear distinction between the following. Fund, a defined benefit, paid contribution into the plan, while account for the cost of fund, a defined benefit plan. We are going to, all these on is just that the key things that we are looking at here is that when we get on, we get to see that there's difference between the defined benefit plan and what we call defined contribution. The defined contribution plan provides benefits either commensurate with the fund available to produce them. And I think I have that one down somewhere so that I want to just give you a summary of it. Define contribution plan, provide benefits commensurate with the fund available to produce them. When we also talk about define benefit plan, provide promised benefits. And so contributions are based on estimates of how the fund will what? Perform. All those we have. So we also see it is very easy in terms of the accounting and what we have. All these other things I want you guys to also get to see. All these are things for you to just read. We look at obligations, we look at the contributions, as we have said. A contribution is a defined, which I've explained earlier, and those are summary. Please note disclosure requirements. A description of the plan must be given. The amounts recognized as an expenses in the period must also be well stated. So that is when we talk about disclosure requirements. Now let's look at some other things we need to look at. And here we'll be going full flesh into a particular topic. Like the one that is contribution is very simple. And if examiner is to ask you, they will give you a procedure. You get to know what are the amount that is being contributed. But when it has to do with defined benefit plan, we need to get to understand the recognition, the measurements, and how we are going to look at this as we move ahead. In looking at it, defined benefit plan, we are saying account for defined benefit is much more complex. The complexity of it is that accounting for defined benefit plan stems largely from the following factor. One, the future benefits arising from the employee service in the current or prior year cannot be measured exactly. So I want you to get that. So that is why we need an actuarial assumption. So you cannot measure it exactly. You cannot just come and tell us that this is the amount. You need an actuarial assumption. And in this case, that obligation, you are saying, okay, if somebody work for your organization, let's say Jane Enterprises, after 20 years, Jane is saying, I'm going to give the person 200 million. Jane, I believe you can do that. We are no more in a situation in Nigeria that you are not getting paid for what you have done. So will you wait in the next 20 years? No. You start making provision for that person. And at that point, you need an expert that will start telling you what is that amount that needs to be set aside. So that when the employee is now get to his own point, he will now get to have his obligation. So you need an assumption. Then the obligation payable in future should be valued by discounting on a present value basis. And I think we all get to know that when we want to know the amount that is to be given for a future amount today, we need to know what is the what? Present value. And another thing you get to see as we move ahead is that we need to be valuing the actuarial assumption, which will lead to what we call actuarial gain or losses. As we move ahead, you'll be seeing me bringing these out in what we have. Now, talking more about the defined benefits plan. Remember, I've told you earlier that this plan is not just something that you just take into consideration and just say you can define what is going on. This is how the plan will work. And I want us to start looking at how this plan operates. In looking at how the plan operates, you get to see that we'll be looking at what are we using the plan for? What is the plan being done for? So if I have what called a defined benefits plan, don't forget we said that plan is going to be something that has to do with my asset, because I'm going to have that asset as I'm setting that asset down. In that case, it's set up in order to meet the future obligation that we are going to get. And let's look at it. The obligation is our liability, while the asset is that which we are using to invest. We're saying that, okay, this is the amount I'm going to invest, and then you get to look at how this will play out. So let me take it this way, is that if you are looking at a defined benefit plan, the defined benefit plan. As you are planning, saying that, okay, this money I'm setting aside is my planned asset. That planned asset is targeted towards what we call an obligation. Let's take this, for those of us that are working, you will see that you are contributing now. Whatever you are contributing, that money is being invested. That amount that is being invested becomes an asset. And what the PFA are owing you to them is what? Is an obligation. Are we getting that now? So when we are now looking at this, there are some associated expenses that you see us looking at. Associated expenses when you have to do that. And those associated expenses are referred to as what we call service cost. And the service cost could be current or could be past service cost. Now I'm bringing up some graph. As you move ahead, whatever you have as your asset, if I have something as my asset, I'm saying that, okay, this is the asset that I have. And the asset I've been keeping for this organization, which will have a value, let's say a balance value for that asset. That asset will not just be dropped somewhere. The asset will be invested. And when that asset is being invested, it means that there will be what we call expected return on my planned asset. So the asset must be invested, and whatever I'm getting in return for the asset will increase the value of my asset. And some other things will happen. What are the things that happen? Will I just leave that asset? From what you have said about that defined benefit plan, is that there will be more contribution. So in that case, contribution will be made more. So when you have contribution paid into the plan, so I will now have contribution paid into the plan. Class, I would like to ask, when I pay more contribution into the plan, what happens to my asset? Will it increase or it will reduce?
It will increase.
God bless you. So that is that. Now, another thing. I've been enjoying, I'm not the only one that they are catering for. Some of the other people that also contribute to us now decided that they are no more interested. They now have to get their own benefits paid. We talk about benefit paid. Once the benefit is paid, what happens to the asset? Will it increase or it will reduce?
Reduce.
Thank you. So that means benefit paid will reduce. Now, as I'm doing this as the entity, that means I as the entity, the company, I'm doing this for the asset. I also have to pay attention to my liability, my obligation. Those obligations will have their own value, which I have as balance brought forward. And on that obligation, I have to look at what is the interest cost. When I have the interest cost on the obligation, will it increase my obligation or it will reduce my obligation?
Increase the obligation.
Thank you very much. Now, when we have service costs being incurred, these are expenses. The service costs could be current, could be past. These are further obligations. And if there are further obligations, will they increase my obligations or they will reduce my obligation?
Increase.
To still increase.
Increase, because I have to pay those services that they render. Now, this is not where I'm going. If you look at that, I stop somewhere. When we are in the asset, benefit was paid. What happened to the asset? It reduces. So if benefits are also paid to the contributors, what will happen to the obligation of the entity?
Reduce.
Benefit paid. Thank you. The benefit will also reduce. Sorry, the obligation will also what? Reduce. And as we move ahead, I want us to see something. Something can also happen. Somebody can move from a plan A, that means from a defined benefit plan A to another defined benefit plan. Like you might have some of your employees that will tell you, "Oga, please, I'm still working, but I don't want to work with you again. I want to go to another organization. You are not paying them out. They are just saying, please, what I have in that fund, I want you to settle me. So what you get to do is that you have to look at settlement. If I'm to ask you that, what would be the effect of the settlement? Because you are transferring to another place. So this settlement is also like saying transfer. Will it increase the obligation or it will reduce it?
Reduce.
It will reduce the obligation. On the other hand, too, whatever is the settlement of this guy, which has been transferred, what will also happen? It will also reduce. But please, I want you to pay attention to pay big attention to this. That value might not be the same. Are you getting that now? The value of the settlement and the value of the benefit might not be the same. Now, having gotten to this point, something will not happen. You have gotten all this value of yours. These are your own value. Because the defined benefit plan is based on an assumption concept. And that concept of that assumption is only given to us by an actuarist. So what you have as a value, the actuaries will now come and say, okay, at the end of the year, this is your value balance at end. And it gives you your own value. That the value of your obligation at the end of the period is ABC. Having considered ABC as the value given by the actuaries and your own computed value, the amount might not be the same. The value might not be the same. And once that value is not the same, that is why we are now going to have what we call actuarial gain or actuarial loss. I will explain that as we move ahead. You can also have this play out when you get to the situation of what? Asset 2. The actuaries will also give you the balance at end, XYZ. The value might not agree with what you have what calculated, and you need what we call a balancing figure here. That balancing figure can also lead to what we call actuarial gain or actuarial loss. And this is very simple. For example, you have a calculated amount of your assets. You said your asset is 10. From your own way, you have calculated here to this point. You are telling us that you're having 10. And the actuaries shows up and say, okay, what is the value of that asset? Should be 8. I'm at a class. Do you have a gain or a loss?
It's a loss.
Careful. Be very careful. Is it a loss or a gain? I've taken your own, brother. I want somebody else to give me answer, and they will explain to me maybe it's a gain or a loss. Don't forget, this 10 is the calculated, computed. Why this 8 is the one that was measured for you. Oh yeah. Is it a gain or a loss? That brother have said is a loss. Are you all agreeing with him?
It's
Class,
a
this is
gain.
not the time. This is not the time for you to be quiet. Tonya, is it a gain or a loss? Actual gain or a loss?
I think it's a gain.
Why do you know it's a gain?
I think it's a gain.
I don't want you to think. Okay, the other brother that said is a loss. Can you explain why? Oh yeah. Okay.
Okay. It's like, oh, how would I put it now? It's like having having surplus, whereas
Listen, class.
no,
I don't want
it's
you
like
to
having
cram
a
it
carrying
because
amount.
okay,
Okay.
sorry. I don't want you guys to cram it. You must understand it because when it comes to the exam, you won't be able to cram. Let's get it this way. The calculated amount is 10. And the actuary now came and said that value of that asset is 8. You said it's a loss. I agree. How? Use a very simple example. Okay. I'm with you. Okay, Yemi, don't be shy.
Yeah, what did you say?
Give me the answer. You said it's a loss. Why?
Okay, I'm looking at it as, okay, if you have something in your financial statement that the carrying amount is 10, and then probably the fair value, the actual value in the market is 8, then that means it's a loss. Now you're just carrying a loss of 2 that you don't
Thank you
know.
very
So you have
much.
to reduce it to 8.
Now,
That's why I
let
said
me
maybe it's a
just
loss.
bring it out very well so that you guys will see what I'm trying to explain. When you talk about planned assets, when you are looking at your planned asset, there are two things that you get that planned asset. Is that you are going to have what called the measured value. And this measured value is given to you by the actuaries. And then you are going to have your own computed value. Now, I don't want us to cram. I just want us to enjoy it, and then you'll be able, because at the end of the day, we are working to get what we call gain or loss on what I refer to as what we call actuaries gain, what we call actuaries gain, and the name of it I'll give you later. We'll call it the measurement concept. You have this to be 10, and you have this one to be 8. You have this one to be 10, and you have this one to be 15. So class, look at this. The measured value is that value that I've given to you by an expert, like what Dr. have said, the realistic value of that asset in market. But what you are now saying that this value for me in my own book is 8. So class, is it a gain or a loss? Because you are not doing what we call remeasurement. Is it a gain or a loss? Is it a gain or a loss? It's a gain, but you know in accounting you would have called this one revaluation surplus. But yeah, we're not going to call it revaluation surplus. It's called remeasurement. Are we there? Of actuarial what gain? Because the measured value, that means the given value in the market is greater than the computed amount. Now let's go to the other side. Is it a gain or a loss? Tonya, is it a gain or a loss?
A loss.
Why?
It's just the reverse side of what you have said now. That's what the actual value, the market value is lower than what you are carrying in your book.
Okay, let me now take you to another page. Don't forget that we are considering two instances. We are considering the one for assets and we are considering the one for liability. Okay, you have told me that one for assets, but will your answer be the same if I get to obligation? And that's why I say you are not going to cry. I have two scenarios. I have what called measured value given to me by the experts, and I have what called computed value, which I have computed. Now this is 2025. I'm comparing, and this one is 10.9. So class, I have this one to be A and I have this one to be B. So which one is gain and which one is loss? Obligation now. Yeah. Which one is a gain and which one is a loss?
A is a gain.
I've been told that A is a gain.
Why B is a loss?
B is a loss. Class, do you agree with that? And I want you to explain that, Tonya. Oh yeah, Tonya, please explain it. So I would now like to give you some format of whatever we now need to do. Because where we're actually going is what we have done there. So I'll just draw it out in a format. Tonya, explain.
So for this, there is an obligation if what the value measured, which is the fair value,
Value. And which
is
is what you
less
must
than
write.
what you have
Calculated. It means you have had
which
again.
and it's less than. It means that your obligation has reduced. That you were carrying a higher obligation in your book, but now with the remeasurement, your obligation has reduced, which is that kind of
God bless you.
a
And
gain.
I want you to know, Tonya, that what you have just done is the right answer. So, having been able to do this, I can tell you that we are through with all our work. And then we are going to now have some formats. I think I want to write this format out in a very clear picture. And then you guys will see how the accounting entry is done. I think that format, I have it in a PDF. Maybe I should send a PDF to you. I wrote it on the board for the professional class, one of the professional class, and I PDF it. So maybe I should send it to you. That will make my job easier. But if you say you don't like the PDF, we might have to also write our own out. But instead of us writing our own out, I can easily just send it to you. I send it to you. I call it IAS 19 format. IAS 19 format. So let me look for that format on my own. Yes, I think I've seen it. So, and I hope you guys will be able to see my writing, what that format is all about. So this is it. Okay. And this is where we are starting from. I think I've explained this. So when you talk about IAS 19, when we talk about like one thing I said, forget that year for second semester. I said I'm going to ask my students here for second semester. And I hope we will still have that second semester this year. So the first thing we need to understand here is that we need what we call the statement of financial position, which is the end of everything we are going. But the one that I gave to you, which I just explained now, I want us to look at it, please, is this. Is that the procedures for computation of the value. You can see on your left hand, you have the fair value of the present value of planned assets, where you have the opening balance. Then after that, you have what called expected return on plan. And how do we get the expected return on plan? That is the rate of return times the amount. Then we have number next, contribution paid into plan. I explained that to you. Then we also have the benefits paid. Then we have the settlement. Like what I explained to you, I said that the closing balance will always be the measured value given by who? The professional, which is an actuarist. And if you look at the calculation I did from the opening to settlement, you will see I call it computed value. And that computed value is what you are going to compare with what is the measured value to know. Maybe you are having the measurement value, which is a gain or a loss. We call it remeasurement on planned assets. So if you are having it as a gain, you see it's positive, but if it is negative, you are calling it a loss. So let's go to the right hand side of the page. You also see we have present value of the obligation. Please, there's something I want you to get there. Under can you hear me, please?
There was a little disconnection, please.
Okay, but can you hear me now?
Yes.
I have to unmute myself. Can you hear me now?
Yes.
Okay,
Yes.
we are back. Thank you. We are moving. Let's move at the fast pace now because I've been in class since afternoon. So let's see what we have. We also get this to give us a remeasurement. And I said, when comparing the value, computed and measured, where the result leads to what? Increase in obligation, it is measured as loss. However, where it is a decrease in obligation, it is referred to as a what? As a gain. Now, all these items that you saw in the account, the expected return on plan, the interest cost, the past service cost, and the current cost will be accounted for in the financial statement. So let's start. The result of our present value of obligation and the market value or fair value of the planned asset at the end of the year must be compared, because that is the singular value. We'll just look at the difference between the two, and that singular value is what we are going to take to statement of financial position. All those accounting and the process you saw me do in that place is aimed at getting the value, the present value of the obligation at the end, and the market value of fair value of the planned asset at the end. And the two values will be compared in order for me to determine what we call the net asset of the planned asset. The net asset, or what we call the defined benefits plan. Then all those other items that we have also used in terms of expenses, they will also be accounted for in the statement of profit or loss. Current service costs, past service costs will be accounted for in the P&L. Now, if you look at this, I refer to it as net interest on defined benefits liability. That is comparing two values. The interest cost on present value obligation will be net, are you there now, with what we call the expected return of plan, which some other instances, they will call it interest on planned assets. Please, the interest on planned assets, which is also called the expected return on planned assets, is an income. So you deduct it from the interest of the present value of obligation. So if the present value of obligation is higher, so it means you are going to add it with the other expenses. But if the present value obligation interest is lower, you will be deducting it from the other expenses. Are you getting that? Then the next item is now the settlement. You must compare the settlement value, the settlement value for the present obligation with the settlement value of the fair value of the planned asset. All things being equal, we assume that the present value of obligation should be greater. But if not, are you there now? You have to account properly and you have to see what you are having. So whatever you are having at the end of that will now be taken to P&L. Now, this is now where I want you to pay attention. All those balancing figures, I would like to ask, what are the balancing figures that we always derive in the planned asset schedule and the present value of obligation? What do we call their name? What is it called? Hello, class. No, we don't just call it gain. It's called remeasurement to be recognized. So, and you don't just say gain or loss. It's called actuarial gain or loss. Are we there now? Actuarial gain or loss. So please, the actuarial gain or loss will be accounted for under the heading of other comprehensive income. While other items such as service costs, past costs, interest costs, gain or losses on settlement will be accounted for under the statement of profit or loss. Any question, please? Is there any question? And I think I've also explained this. This is the one we did earlier that I was explaining to you. Any question, class? F down. Okay, if there is no question, let's move to the question we have in our pack. I think I've explained this. We've looked at all these ones, the course. If you want to read more, you can see all this I've explained with that chart. So we also have what called constructive obligation. This may be a conduct which may arise from entity, informal practices, all those ones are that. So let's look at question number 5. This question number 5, this is what I always do. Class, I don't solve this question for students. So I'm going to give it to you. This question number 4. So you are going to work it out and you will tell me what is the amount. Are you there now? To be recognized as a remeasurement. Oh yeah, Ejo, I saw them. I saw. Oh yeah, what would be the answer? Hmm? It looks like why? It's actually for my own way of making you to get something. If you look at it, let me just help you out. Prior year, you have 0. The second year, you have 131. How do I get 131? You start seeing the benefits being accruing over the period of time. But I won't want us to look at this. This is just for theoretical things. If I want students to just get confused. But that is not good as an examiner. Please, all these costs, I think I've explained this. Service costs, net costs will go to P&L, while the remeasurement on the net defined benefit plan goes to what? OCI. There's a question that I always like you guys to solve, and I'm not going to be a party to that question. This is question number 5. Yes, this is the question I'm looking for. I think you have the question now. Can somebody read the question for us? I'm not going to solve it. It will be your question, then I'll be able to know. Maybe you understood the format. You have the format I've given to you, and you have the question. So can somebody read that question 5 for me, please? Oh yeah, I can. Hey, Joe. Okay, Jane, read the question. Please, class. Oh yeah. Is there nobody there again?
At 4th of January
Mm-hmm.
2002, the fair value of the assets,
Mm-hmm.
fair value of the assets of a defined benefit plan were valued at 1.1 million, and the present value of the defined obligation was 1.250. On 31st December 2002, the plan received contribution from the employer of 490,000 and paid out benefits of 190,000. The current service cost for the year was 360,000, and the discount rate of 6% is to be applied to the net liability or asset. After these transactions, the fair value of the plan's assets at 31st December 2002 was 1.5 million. The present value of the defined benefit obligation was 1,553,600.
So calculate the gain or losses on remeasurement through OCI and the return on plan assets, and illustrate how this pension plan will be treated in the statement of profit or loss and other comprehensive. So class, you have 10 minutes. No, you don't even have 10 minutes, so you have 5 minutes. Oh yeah, solve. According to my time, yeah, I'm having so 6 minutes. Oh yeah, please. I don't think you need my slide, or you still need it because I want to take it off.
We need it to.
Okay, oh yeah. You are going to give me your values. Ejo, ẹ fún mi lánsà. We have 5 minutes, 4 minutes more. Okay, what's your answer? Can we move on? Have you been able to get your answer? My people, answer. Okay, what's the remeasurement for asset and the remeasurement for obligation? Mo ń gbọ́ yín o. Pardon? Okay. Can I solve mine? Hello?
For plant assets,
Yes, I love that, my brother. For plan asset, what's your
34,000.
answer?
34.
Is it a gain or a loss? Is it a gain or a loss?
A loss.
34,000 loss. Are you sure, my brother?
Let
Okay,
me
we'll confirm. At least you have a value. For the obligation, uncle.
I've not done the obligation.
Well, you know you can do it side by side. Okay, let me get to enjoy what you guys have done. I would say I'm very happy. At least one person could give me answer. Or you want me to still give you enough time to do the other one? Did I give you enough time?
Yes.
Okay, oh yeah, I'm still giving you time. I think you have the question because I've taken it off the screen. I don't know, for those of you that are here, is it true that the curfew has been extended to 6 a.m.? Okay, you can't say. What's the name of the entity? Does it have a name? Now I believe they just say we should calculate the list for question 5. How we have to do computation of gain or losses on the measurement. So I'm going to have my planned assets. I'm going to have my obligation. And I think we are working in, can I work in thousands? So let me just work in the naira. Are you guys true? Hello? Can I go on? Dami, any answer? Tonya, Aziz, Taufik, Okwe has gone.
I didn't get it.
Oyelere. Okay, let me just take it there from there. So from what we have, we are told that we have a value. So we're told on fair January the fair value of the asset is how much? The fair value of the asset. So I
The
have here
asset 1.1.
1 point what?
1.1.
1.1 million. That's for the asset slash, and I've been told that the present value of obligation is how much?
1,250,000.
1.250.
1,250,000. Okay. Now in this case, I now need to get their interest. Please be very careful. The interests are not just one figure to be on each other. So let's go for the interest. So I'm going to use the word expected return. That is the one for asset. That is 6% times 1.1 million. Give me an answer. What will be the value of that?
66,000.
That is 66,000. Now, I now need to calculate the one for interest cost. For interest cost, that is 6% times 1,250,000. So what would that give me? I need your help. What would that give me, please? Class. Give me answer, calculator.
75,000.
Yeah, I need you to be with me. I don't have calculator with me here. So I haven't done that. I now move further. They now said that from the question on 31st that the letter receive a contribution from employer. So we are now looking at contribution. So we now have contribution. The contribution, how much is it?
490,000.
So contribution will increase my assets. Yes or no? Will it increase my obligation?
Yeah.
Does it have anything
No.
to do with obligation?
No.
I have that. Okay, let's read on. The next item I now have. I'm paid out benefit of 190. I now paid a benefit of 190. So I now have benefits paid. You can see now it's not compulsory you follow that, but you know what? So if I'm paying 190,000 as benefit, the assets will reduce by 190, and then the obligation of the contribution will also reduce by what? The plan will also reduce by what? 190. Next, what do I have? And I told that the current cost for the year was how much? 360. The current cost is 360. Cost is not going to affect my assets. It's going to affect my obligation. Current service cost, please. The word is current.
Service.
Yes, ma'am. Yes, madam.
No, I'm fine.
Okay, thank you. Then we are now told again a discount rate of 6%. We have done that already. I think all the values has been taken care of. So let's now get to the value at the end. We're told that the value of our asset at the end, which is now the value at end, because we are told that the fair value, I think this one is at 1st January 20x2. So we are now having our fair value slash present value on 31/12/20x2. What is for assets?
Asset is 1,500,000.
1,500,000. What is for liability?
1,553,600.
155,600. Okay, let's now get our remeasurement now. Now it's very simple. Can you calculate all the figure that you're having here? So let me take it to another slide so that we enjoy it. So what we're having now, we have that of assets and we have that of liabilities. So what we're having is that we already have what we call the measured value. The measured value for this is 1.5 million. While the measured value for the other one is 1,553,000. Am I correct? 600. So I now need the computed value. So what is the computed value? So calculate the computed value. Let's go back to the other page. What is the computed value that you have here? What is our computed value?
I need
Hello,
to go
class.
back to that. We can't
Hello.
see it. I can't see it.
I hope you guys can hear me.
I can hear you.
I think the network is going off. Hold on. Just give me some few minutes. What do you call it? My electronic board just decided to restart himself. You have to just give me some minutes. I don't know why he has to shut down. Please just hold on. My electronic. So, but in your own case, what do I have as the computed value? So please just fill in that gap. I have to restart my device, the board I'm using. Please just hold on. I will be with you in a minute. The board is coming up. Is that means I have to reload. I have to go to the Zoom. I hope I still have that my note. Thank God I still have it. Thank God I still have that note. And with you, please, I'll join you now. I want to log in. I need the account number. That's okay. I think I'm cool. I'm cool with this one. I need to go into my Zoom. Please just give me 2 minutes. I'm trying to connect back to Zoom so that we can use the board. Sorry, I will join you now. That is 593. Pardon me, 1 minute more. I'm almost there. Please, I'm sorry. Okay, but if any one of you have gotten that figure, please just go on with it. Give me that figure so that we now know what I have. Okpayemi, what is the computed figure for assets? Okpayemi is not with me again. Taufik, what's the computed figure for the assets? Taufik, what's the computed figure? I'll say I'm back. Okay, I think you can all see my board now. Can you?
Yes.
Okay, thank you. So I have to move on. Thank God that it's electronically saved. So what is the computed value for assets?
I got 146.
1196.
You got what, please, ma'am?
What I got is 1466.
1466. Okay.
Oh,
So what is the difference
Right.
between the two? What is the difference, please? What is the difference, class? Oh yeah, I guess it's 34,000. That is 049. So that is it. So in this case, class, is it a gain or a loss? For assets, is it a gain or a loss? Is it a gain or a loss?
It's a loss. Eh?
It's a loss.
Huh? No, it's a gain.
How do you know it's a gain? You can see, that's why I said I
No,
don't
it's a
want
loss.
you.
Actually, it's a loss. It's a loss. It's a loss.
How is it a loss?
Because the computer value is more than the carrying value.
Are you sure?
What?
Go back to
Wait.
what we
Okay,
did.
we're comparing. Oh, okay, okay. We're comparing
We
the
are looking
the
at
measure
assets
value is
now.
in 1.5 million. Oh, okay.
We are looking at assets. We are under
It's
assets.
a gain. It's a
It's a
gain.
gain. Okay, what's now the
Yeah.
computed value? What's the computed value for obligation? What's the computed value for obligation to this? So we already have this one as a gain. We already have it, that is 34. So I'm saying the measurement. Are you there now? Of planned assets. We all agree it's a gain. And don't forget, it's a balancing figure. We got these amounts back. Okay, let's go for the one of what is the computer value for liability? Class, I need your
1495.
1495. Are you sure? Please confirm again. Add everything together.
1495.
And I'm sure you deducted 90,000.
190.
190.
You deducted 190. So what did you have?
Yes.
1495.
1495.
Okay, so what's now the difference?
Difference is 58,600.
600.
58,600. So I'm agreeing with you. 58,600. So class, is this one a gain or a loss?
It's a loss.
Okay. So let's just
It's a
have it.
loss.
So you said 58 what? 600.
600.
Because the obligation is increasing. Yes or no? The measurement of what?
It's increasing.
Okay, obligation plan. So that is that. So class, all what we have done now is we have been able to get all the figure, but the examiner said he wants to see how all this will be presented in our statement. So let's go to how we present them in our statement. So the first statement we need to look at is the statement of profit or loss. So the statement of profit or loss. So in our statement of profit or loss, what will I have? What are those things that are expenses that must be accounted for in my statement of profit or loss? Will I pick the fair value? Will I pick the fair value? No. So the first thing I have to look for is the net interest. So let me go for the net interest. So and that net interest is well defined. So I need my net interest. So I'm going to call it my net interest on net defined plan. So you can say net defined liability. So I need your help. What is the amount that is the interest cost? What is the interest cost that you calculated? Oh yeah, hey Joe.
Asset is 66,000.
No, for obligation.
Obligation
75,000.
75,000.
For obligation is how much? 75,000.
75.
75,000. So let me take that interest cost as 75,000. So I have that as 75,000. Then what is the expected return? What is the expected return? Class, what is the expected
66,000.
66,000. So it means the expenses is still more. So what is now going to be the net? 9,000. And please don't forget, these are list of expenses. So we are taking that. So please, expenses is more. So that, please don't forget, this is the expenses column. Now let's go on. The next item we have is also what that must go to P&L. Contribution, will contribution go to P&L? No. Will benefit paid go to? No. So what will go there? We have our current cost. So what is the value of our current service cost? Current service cost. What's the amount? I need your help.
360,000.
That is that. Is there any other thing going to P&L? There's none. And don't forget this, we are looking at extracted. So what do I have next? The next item we need to look at is the ability to look at that. Excuse me. Please switch off that generator. Hello, class. Just give me a minute, please. Yeah, class, I'm sorry. Let me just wrap up so I'll attend to what I need to attend to. Pardon me for that. So please, let's just wrap up what we have. Then for the OCI, please, are you guys back? I'm sorry about that. I just have to attend to some. So I haven't done that. The last thing we now have is what goes to the OCI, other comprehensive income. So other comprehensive income. So in the other comprehensive income, what we are having is that we are having two items. We are having the gain and a loss. So if you look at that, so what are we going to take into our other comprehensive income? If you are having a gain of 34 and we're having a loss of what, 58, so that means we are having a further loss. So if you want to just have it, let's just have what we call the measurement of gain on planned assets. That gives me an amount of how much? That is 34,000. Then when I now have remeasurement of what? Loss on obligation. And that gives me how much? That is 50 what class? 58,600. So we have a net of that. So if I'm going to take that to my statement of financial position. So if I'm going to my statement of financial position, what will be the net of the value? And I need to get the net of the value. What's going to be the net of my benefit plan? Benefit plan liability. So I need your help. What was the amount for the liability as at the end of the period? That is 1533. That is 1533 600,000. So let's take that. So I have that as 153. Is it 1533 or 153? I need your help. 153 600 minus 1.5 million.
553
Okay.
600.
So what is now the difference? And that is the difference that will be written, recognized in our statement of financial position. Please, I need your help. What's the difference? What is the
53
difference?
600.
So the answer is 53,000, 53,000, 53,600. So we need to explain this to the directors. Those are the things that are going to be the real figures to be considered. Okay, I want us to stop at this point so that we can have some other things to do as we move ahead. Maybe in the next class, I've been able to explain all these, and every other thing you have there is just summary of what I've done. You're going to see how the past course is to be accounted for, and all what are the other things. So I'm going to give you this as an assignment. So these ones are still the explanation of all what I've explained to you. You can see debit the past cost, credit the present value, and the remeasurement as I've explained them. Are you there now? So let's now go on here. We are now moving to number next. This one I've also looked at this in terms of the Jubilee things. So here now, IFRS 9, we've also looked at it. So please, I give this quiz. I want you to look at this as your classwork. So please, I want you to attempt this question and tell me what is your answer. So I'll be expecting solution in the next class, please. Or you submit it to me today, please. Any question? Any question, class? So if there's no question, I want us to use this method that I've taught you, and it's the same thing you're also going to use to answer the question that I've given to you. So please, there's nothing difficult about IAS 19. This is IAS 19 in its own form. So please, is anybody having any question? Any question for me, please? Any question, class? Ẹ sọ̀rọ̀. Oyinlere, Oyelere, Aziz, Dami, Tonya. Is there any question, please?
Hello, yeah, Miss Emma.
Yes, please.
Yes, the question is that this format for present, future and present, future asset and present obligations.
Future
Is
asset care or fair
I mean,
value
sorry, fair value
and present
and the
value.
present value. Is there
Yeah.
any other thing that the examiner can ask that is not included in this
No,
question?
the only item that is left and which I'm also going to send to you as is the word of settlement. And there's no settlement in this question. But in that which I've given to you, you're going to see settlement. And you see, while I was explaining to you, I also explained settlement. And I have my reason why I explain settlement for you. Because I want you to be able to understand all the fundamentals. And that's why I explained that settlement for you.
Okay, that's all.
So what I want you to do is that there's a question in the material I sent to you, which is question number 6, and that is on page 19. So I want you to practice that question for me. Are we together?
Okay, thank you.
So that is it. So if you have any other question,